Hi, I'm James Dunn. Welcome to the Inside Network. Joining us today to discuss the Trilogy Funds management approach to investing in property is Head of Direct Property, Laurence Parisi. Laurence, great pleasure to have you here.
Thanks for having me.
Laurence, you've spent many years as a property analyst and investor. How has that body of experience shaped the way you think about risk, value and opportunity in today's market?
Spending time as an analyst and investor over the last 25 years has taught me that the real risk in investing isn't about the volatility, but the risk of permanent capital loss. And how that shaped my view going forward has been focusing on what can go wrong and what can I do to help mitigate the risks. The volatility and noise often leads to opportunities. You need conviction to be able to look through that and revert to the ultimate objective of what you're trying to achieve.
How does your own investment background align with Trilogy's philosophy? And to what extent does the risk profile of your end investor influence the way you build and manage property portfolios?
My personal philosophy on investing has really centred on being risk aware, a heavy income focus and having an appropriate time frame for your investment objective. And that is very much in line with what we try to achieve at Trilogy. When we're either constructing a portfolio or an investment, we obviously always come at it from a lens of income, risk awareness, capital preservation. That always comes back to the quality of the assets that we're acquiring, the credit worthiness of the tenants, and importantly, the capital structure that we house those assets in.
Laurence, of course, we're here in March 2026 and macro and geopolitical risks have really come to the forefront in a huge way. Listed markets obviously have been very, very volatile, but property does, of course, react more slowly to events. Based on your accumulated experience, how are you seeing the next 12 to 24 months, the outlook in the commercial property markets?
Yeah. Well, obviously you're right, the listed market's going to continue to be volatile both domestically here and internationally. As you're aware, real estate is illiquid and therefore it's not priced daily. And that often benefits investors who have the discipline to be able to look through that, and it mitigates us from making irrational decisions. Where we ultimately see the opportunity is where vendors perhaps are taking a shorter term approach and being reactionary, which will then ultimately create investment opportunities for us being a long-term investor.
Across the commercial, retail and industrial sectors of your market, where are you currently seeing the most compelling opportunities? And conversely, where are the biggest risks that give you pause to maybe think about that outlook a bit more deeply?
Yeah, we like to focus on the subsectors that have structural tailwinds as opposed to cyclical tailwinds, and to zero in on that, we as a house have a very strong conviction on convenience retail assets as well as industrial. If I take a moment to just explore why we like those assets from a convenience retail perspective, underpinned by migration and population growth, urbanisation and density, there's a very strong non-discretionary element to it. And ultimately, we as Australians are time poor, so the convenience nature of those assets really does underpin the investment philosophy. And if I move to industrial, similarly from a population and migration perspective, that's going to underpin the level of demand required for industrial space. The automation, the continued growth in e-commerce will all underpin the fundamentals of industrial property going forward. And I'd say from a risk or being more aware perspective, office, whilst you need to be selective, the backdrop does still remain somewhat uncertain.
When Trilogy is assessing a property, what are some of the key metrics you're looking at, some of the red flags you might notice, some of the tenant considerations? And then how do those factors shape whether you're predominantly pursuing an income-oriented purchasing strategy or growth-oriented, or a total return view of the asset?
Yeah. From Trilogy's perspective, we're always focused on income and the quality of that income, and that's ultimately dictated to by the tenant and the creditworthiness of that tenant. We also have a lens of asset quality. Where is the asset located? How new is it? How relettable is it? In the event that that tenant vacated the property, how quickly could we find a replacement tenant? Red flags for us immediately are poorly located, a secondary quality asset that might have too much capital expenditure required, too heavily reliant on a single tenant and the creditworthiness of that tenant. So not too dissimilar to residential property when you're focusing on the red flags. At Trilogy, we always focus on income. We have a view that if you focus on the income and maintain the income, capital growth will typically take care of itself. And I foresee the next 12 to 24 months is going to be a market that's more income-led than total return-led, and that is very much in line with how we build portfolios.
Laurence Parisi, Head of Direct Property at Trilogy Funds Management. It's been a pleasure having you in our studio today.
Thank you.